welcome on board Rahul Arora. Rahul, great to have you on ET Now. Thank you so much for your time. So let's first talk about the US equity market weakness because it seems that the MAG 7 shake-off is finally happening. How long would it persist?
First of all, thank you for having me on the show, Aisha. It's good to be back.
Yes.
So I think obviously, the one trigger that the Indian markets had going into the Bihar elections was that could be the trigger for a new high. And unfortunately, the Dow spoiled that party, being about 600, 650 points down the previous night. But my sense is that I think if you look at valuations both in India and the US, I think they are a bit challenging at this point. They were. And I think, which is why you're finding a lot of foreign investors looking at China as a reasonable alternative and other Asian emerging markets at this point in time. I think this correction was long overdue in both markets. I think India has been more of a time correction and US more of a price correction. But I think all eyes are on what the US Fed might do next. I think in December there is a 50-50 chance that there may be a rate cut of 25 basis points. There are still a lot of trade deals to be struck across the world, but I think if you looked at valuations in the tech sector, whether it was Apple, whether it was Nvidia, they were all becoming a bit excessive. They were reaching levels that were not supporting the return on capital employed that these companies were making. So I think it's a welcome correction. Obviously, this will have impact on resultant flows into the Asian emerging markets and global emerging markets, but I'm hoping this tides over, before by Christmas or before, maybe a little sooner, because typically the US markets go a little soft towards the back end. So overdue, not too worried, but hoping for a resolution in the not too distant future.
And what's the impact of that on India, Rahul?
I think I think it'll mostly be from a flows perspective.
Sure.
I think not too much otherwise. The US Fed and India have been moving in tandem as far as rates are concerned, give or take. I think our inflation heading practically towards zero is a positive for us, but I think it's more from a flows perspective. But I think the bigger thing here, I've been listening to a lot of commentary of a lot of economists talking about how tariffs are a little lower in some of our neighboring regions and why 50% for us. But I think the big trigger from a US-India standpoint could be if that 50 comes down to say 35, 30 or even 25. That could be a big trigger. But otherwise, I think purely from a flows perspective is what we're looking at.
Rahul, you track the FMCG and the QSR sector very closely. What's your view after the Q2 earnings for FMCG and QSR?
So honestly, I think, Sajid, overall consumer I wouldn't touch right now unless it's discretionary. I think if you looked at volume growth in consumer companies, it's been a disaster. I think Lever was 0%, something like an Emami was minus 16%. I think even in QSRs, I think if you look at Westlife's numbers, if I remember correctly, it was a negative 3% same-store sales growth. And even Jubilant, even while the market got excited with that 7 or 8% like-for-like growth, they forget it comes on a 1% base. So comparatively to that, I would prefer consumer discretionary names because I still don't think valuations are capturing the weakness in the volume growth in consumers overall. I think what stood out for me was something like a Marico, something like an Asian Paints, where you had very good volume growth. Marico, even on the international business, did very, very well. Though if you see Marico, the growth came at the cost of margins. So there's a huge knockoff on the gross margins. And I think in FMCG, a lot of companies will have to make that trade-off between growth and margins. But I think if you looked at, say, Paints, which is seeing a revival, something like a PNG and a Gillette, where the not very widely tracked. We were one of the few brokers, or rather were one of the few brokers who used to track it. 42, 43 times for virtual monopolies. I think if you looked at Gillette, there is no number 2 competitor. I think even if you look at PNG, Whisper is still holding market share. There have been a lot of brands, like private labels that have tried to come in. They have not succeeded. There have been certain Japanese players that have come in that have not sort of taken that. And these are 100% plus ROE, ROC businesses that you're getting at 42, 43 times. So I think consumer staples, the only thing I'd probably look at is ITC and Marico. On the discretionary side, I think Asian Paints. And I think if you extend that to alcohol, I think, as you enter the summer season, I think this is not a bad time to be accumulating UB or UNSP. And I would say you could probably trade out of some of the hotel stocks because the valuations are not very cheap, so to speak. Of course, you're in wedding season, but I think there could be a trade-off between hotels to some of the alcohol stocks or the aviation stocks. So more positive on consumer discretionary than consumer staples.
So the paints segment, you said Asian Paints. It seems that the company is more in favor of maintaining a market share using volume growth rather than margins and profitability.
That would be the case across the board, Sajid. I think, even if you look at something like a Voltas, right, from the durable space, way back, you remember this was a company that used to be at 25-26% market share. It's down to 18%. Conversely, someone like a Blue Star, which started this business only in 2012, is up to about 14-15%. So I think a lot of companies will have to take that trade-off between growth and margins, and that's why I think valuations are going to be very challenging. I think the market will have to sort of align itself on what you're buying. So I think in the case of IT and FMCG, Sajid, there are 3 or 4 things that people buy them for. One is, I think, okay, let's just put this into context. If you look at 2010-11 to about say 2022, when lever went from 300 to 3000, right? It went up 10x. What happened in that period? The top line didn't grow. Lever only compounded by 9% on the top line. But that 12-13% margin went to 25%, which is why the stock went up 10x. So you will have to choose something. So you either choose margins, or you choose market share, or you choose growth. Or then sometimes people buy IT companies for the cash and rupee depreciation. You can buy FMCG companies for the same. You won't find leverage in either of these two sectors. But like I said, I think you need to buy these companies for the right reasons. But that being said, I think the food side of the business isn't doing too badly. Something like a Tata Consumer or Britannia or a Nestle aren't doing too badly. That could be an interesting pocket in the consumer space as well.
But Rahul, now that we're almost done with the Q2 earnings season, where is it that you see the profit pools getting created? Because, I mean, if prima facie you take a first glance, the positive surprise was in banks.
I think that is absolutely where I would still be buying. Now, you would say that, okay, valuations are not cheap because I think ICICI, Axis, Kotak would all be trading at about between 2.4 to 2.7 times price to book 1 year forward. While that may be expensive to the rest of the pack, this is nowhere close to the historical highs these guys have traded. They've all traded between 3.5 to 4 times at their absolute peak in the previous bull cycle. That being said, there are a lot of NBFCs that are still trading at 4.5 times. You have enough examples, actually between 3.5 to 4.5. You can have Avas there, you'll have Aptus, the Bajaj twins, Home First. There's a lot of these guys. So why can't our banks go there if net interest margins are in the process of bottoming out? So you said, where will the profit pool come from? So I think the net interest margins for the banking sector are in that process of, the decline is practically over, because you started to see a sequential improvement in net interest margins, not just private sector. The largest elephant in the room, which is SBI, showed a sequential improvement in net, which was phenomenal. I think asset quality is improving. I think we're done with that last leg of, for people who can take their memories back as far as, maybe 10 years, infra, real estate, all those NPS, telecom, I think all of that is done. I think if you looked at the last set of data that came out for the sectoral deployment of credit, credit growth has moved into the double digits. It's moved into 11.5, which was moving in that 9-10% range. So if NIMs have bottomed out and they're going to expand sequentially, if asset quality is a thing of the past, most of these banks are well capitalized. Most of the banks today are trading, if you exclude the 3-4 major names that I took, the private sector ones, they're all trading at ROAs of about 1.3 to 1.6 and ROEs of between 13 to 16. For that, you're getting the banking sector between 1 to 1.5 times. I think for me, it's a no-brainer to be buying banks. You could extend that to NBFCs as well, including gold finance. I think auto finance is doing well. I'd still be a buyer in dips in something like a Chola, which looks pretty interesting. I'd be a buyer on dips in something like a Muthoot, which looks fairly interesting. So I think if I was to recommend a basket, if you will, I'd say SBI for sure in the public sector space. HDFC Bank still, even at these valuations, looks all right. We could look at an Avas. You could look at maybe on the insurance side, ICICI Pru Life looks like an interesting bet. So these are some of the names that come to mind. And I think asset management companies also look like an interesting play. These are steady state, 30-35% kind of ROE, ROCE businesses. Mutual fund inflows have been good. So I think that's probably how I would build my portfolio, but my biggest overweight would be BFSI.
Rahul, why only SBI out of the PSB pocket? I mean,
we could look at a Bank of Baroda.
Okay.
Yeah, we could look at a Bank of Baroda as well. I think I wouldn't want to go too far down because I think I would not know what the future is. See, we're 2 months away from a budget. We don't know what in terms of if there's any public sector consolidation that's announced. So I think, there are, I think, if I'm not mistaken, about 50 or 55 stocks that most sell-side analysts track today on the BFSI sector, and most of them would have at least 2 or 3 lead analysts. So I'm not compelled to go down that value chain when I have so many more options coming in and so many more new listings as well. I mean, even, you know, if you look at some of the newer listings, like if you look at, say, a Policy Bazaar or a Paytm, I think they've learned their lessons after listing. I think they chased market cap, but they suddenly changed their focus to cash flows and, you know, cost control and things like that. And it's reflecting in the cost to income ratio. So I think it's not because there is a lack of, you know, it's actually more a choice thing than a preference thing. So I think if I was,
plenty is what you
so I
mean.
think probably SBI and Bob would be, you know, pretty much where I'd want to center that.
The entire rally of the banking is led by PSU banks, not just SBI but others as well, right? Do you see that as a PSU cohort, the valuation gap between private and public is now narrowing to a level because of the asset quality, the credit growth which is coming in, and the NIMs which are now inching up for them?
But Sajith, even after this rally, SBI has gone at 1.5 times.
True. That's
You know, so
that's something.
I
Is
mean,
there a
look at
room for more?
So I still think so. I think there's a full one-time price to book available, or a little 1.2, 1.3 between, say, an SBI and, say, an ICICI bank. So see, I think traditionally we've seen about 25 years, 30 years. There is always that mindset कि ये PSU है तो इसको इतना इससे ज़्यादा multiple नहीं दे सकते. So I think that still prevails even today. I don't think it should, because for the size of the balance sheet that SBI and Bob have, if these are the, I mean, SBI is still almost a 14% ROE company. There are defense companies, Ajit, that are operating at 15, 17% ROE, ROCs, and you're happy to give them a 35, 40, even 45 times multiple because you say, oh, this sector is, you know, now coming in. But this sector also is coming out of, you know, years of underperformance, under ownership. That's a technical factor as well, because monies can flow very quickly. And to your point about, you know, we were discussing flows, if FI has come back, this is the first sector they're going to go into. So I'm not sure how much that gap will narrow, but I still think there is a case for some of these stocks to go up at least 15-20% from here, despite the rally that they've had.
Rahul, you spoke about how valuations, especially on the private sector side, have come off from the highs. Why do you think that is so? That's the first part. And how much can they go back? Because now you have sizably larger balance sheets. HDFC is now sitting at 25 lakh crore in terms of a balance sheet. Not easy to grow the way it used to, 18-20% on loan growth. How much of that is warranted?
So I think there are 2 or 3 things here. One is, I'll go back to the technical factor that I was saying of ownership. Now let's take a case study of Bajaj. Right, it was totally ludicrous, the market reaction, because he lowered his guidance by 1 percentage point at the upper and lower end, and you're down about 8-10%. I mean, what margin for error do you have? And it's not like this is the first time this has happened. This has happened with Asian Paints, right? This has happened to me even when competition has come in. So, you know, we grew up at a time when HDFC Bank used to compound at 25%. Now you cannot compound at 25% given the size of the balance sheet. DMart has faced this as well. It went through a very sharp re-rating where people were so used to a 30% growth that they said we will not accept a 25% growth. So I think one is that realization that these companies cannot grow at 20% from here. They'll at best grow at 15-18%. So that then you ask the question, for a 15-18%, do I need to take it up to 3.5, 4? My point is, you can probably at least take it up to a 3. So which is why I said I think even private sector banks that are at 2.5, 2.8 can be bought even today, because you can take it back. And I think, you know, the thing that happens, Harsh, is if you go back, I say 20-25 years, I don't think there is a single India dedicated fund that's opened up globally. We're still part of Asia Emerging Market and Global Emerging Market Fund. So there is no dedicated person who has come and said, okay, this is $1 billion here. And what happens is, you know, as one fund manager, one very large fund manager once told me, हमारा market किसी का सगा नहीं है, if we are an FI, right? उनको पैसे बनाने हैं. So if they feel that valuation will go, will come from Vietnam or China or Thailand, they will move. And, I remember Mark Faber had said that, and he eventually moved to Thailand, because of the amount of money that he made there. But I think if flows were to come back, they will come back around. And it's not just private sector banks that have seen a reset. I think going back to the point I was making about Voltas, if you see that sector, it had become so overowned. You're seeing a reset even happening there. So it's not just banks. I think wherever there was a technical over ownership and earnings have not lived up to the mark, the margin for error, what Asian Paints, DMart and now Bajaj shows us, is you practically have none if you're trading at the top of the tree.
Where else do you feel that concentration pool right now, where you feel that, you know, the market is overpaying the price for where these stocks are sitting?
I still think defense, Aisha.
Yeah?
I still think defense. I think, you know, if you exclude, say, something like a Hindustan Aeronautics or a BEML, I think if you look at, say, names like Paras, Data Patterns, Astra, I mean, there are quite a few more in that list. They're still trading at what, 40, 45, 50 times 1 year forward. Again, going back to the point, you can't be paying valuations of 2 times return on capital employed when the growth rate is 15, 18%. Then why not pay that same thing to, say, performing FMCG, performing banks, performing IT? I would still say mid-cap IT, while it looks ridiculously expensive if you look at names like KPIT or Persistent and the likes, Coforge. But there's still companies that are growing 25, 30%. So I think defense is another area. I still think some prices can come off on the durables and electrical side. I think even for the kind, see, we had a prolonged monsoon and you had an early winter onset. The fact that you wake up in Bombay and find people wearing sweaters at 6:30 in the morning means kuch to gadbad hai, you know. So I think it's going to be a slightly, you know, pressure period for the likes of Blue Star, Voltas. But these are fantastic franchises. But I still think valuations can reset. So defense, I think durables and electricals. I think consumer also by about 5-10% could probably reset on the way down. Maybe still chemicals. I think there's a case for 5-10% reset on the way down. Not ag chem, more on the specialty chemicals and ingredients front. Yeah, I think these are pockets. I wouldn't say valuations are excessive. Like what has happened with IT.
With caution.
Yeah, I think so. So IT has given you a very good time in price correction. So I would not mind nibbling into IT right now. I'd still have a neutral stance, but I wouldn't mind starting to nibble into large cap IT right now. So these are some pockets where I think defense, clearly there is the largest, you know, sort of reset that needs to happen. I think there's a case of 15-20%, but in the others, another 5-10%, and I think they'd start to look like interesting entry points.
What about real estate? I mean, that's a sector which has been doing well this year, right?
I think it's a knockoff effect of the market, Sajid. I think the fact that, you know...
The wealth effect.
Yeah, I think I read recently that DLF launched another project recently in Gurgaon. And I think this was about 3-6 months back, and they wrapped up like 11,000 crores in a week or something like that. So I think it's a knockoff effect. I think, you know, there was a global media house that actually carried an article, which was a very interesting one. You'd remember, Sajid, there was a time when promoters used to sell stake and the stock used to get derated. There's actually an interesting study that a global media house had done that said that second and third generation entrepreneurs, the kids don't want to work as hard as their parents and grandparents. So what they're doing is they're selling their stakes and putting up family offices. And these are they're selling their stakes at discounts, right? So the point being here that a lot of the money that was created through equities has flown into real estate. I don't think some of these prices are sustainable. You'll have to go very, very micro. You know, there will be instances where a certain development can impact real estate prices. Let's take an example of Bombay, right? So South Bombay, nothing has happened, but the coastal road came in and prices went up by 10-12%. From not too far from where we're sitting, there's going to be a Sivri-Worli connector that comes up. Prices are going to go up by 10-15%. So these are very specific. But you know, to the point I was making about the switch from hotels, I think it's very difficult now if salaries are not like, I'll tell you, Sajid, in financial services, the kind of bonus payouts that we have seen in our industry or even the side or FSI as a whole. I'm not too sure about B, but FSI as a whole, if you know, sort of widen the pool, have been ridiculous. I think, you know, you've had 100-150% bonuses that have been paid out. Where has that gone? That's gone into premium real estate, luxury cars, gold to a large extent as well. I think that's where a lot of this asset price inflation has come. But I would, Sajid, still stay with, if I was to buy real estate today, I would probably look at buying it through REITs. I would not probably go directly into real estate. I would probably look at REITs. You have enough and more. You could stick with the leaders if you want that embassy mindspace and the likes. But if you have to buy stocks, I'd buy stocks where I'm comfortable with balance sheets. I still think something like a Prestige looks good. I still think something like an Oberoi looks all right. DLF has got, I think DLF from 10 years back to where it is today is a huge sea change. I think Shobha used to be good, but I think they're, you know, the extent of the projects that they're putting up in Dubai is a bit of a pushback get from institutional investors that, you know, that otherwise it was the darling of the stock market. But I don't think you can expect the returns that you have, say, got in the last 2-3 years. But my preference would be through REITs. But if not REITs, I would say something like a DLF or a Prestige or an Oberoi is where I would look to park some of my
Do you
money.
look at the valuation parameters which are coming in? If you remember 10-15 years ago, it used to be land bank based valuations. Now it is pre-sales based valuations. In fact, we are not able to see the cash flows coming in, but the pre-sales based valuation. Do you think that at some point in time it will crash, or there will be a rationality which will come into real estate companies?
So I think, Sajid, the time has come to value them on price to earnings. I think that's very clear. I think the rest of it is very subjective. You're absolutely right. Not too far from where we're sitting, DLF had acquired a very large land parcel, which then eventually got sold to Lodha, and it was supposed to be something else, but it's a residential complex so I think there was a time when people were just going out and buying land, but I think the one thing that happened to corporate India overall, real estate included, Sajid, during the lockdown, the balance sheets got repaired. And I don't think today, I think that the challenge that corporate India as a whole has is a mindset issue that हमें अब debt उठाना ही नहीं है. And I think which is why you're finding real estate companies also innovative ways of sort of raising money because they're too scared to go down that debt angle, which is why the land acquisition story has come down. They're funding it through, as you said, pre-sales or their cash flows. But I think if we are valuing everything on the same parameter, I don't think, because, to the point I was making about Paytm, Policy Bazaar, Nykaa, Zomato, all of these went up 2, 3, 4x after the listing and all became a 4th, 5th, 6th of their prices before they learned that they had to focus on cash flows. So if you're going to go back to focusing on cash flows and profits, I think the time has come to leave the subjectivity out of it and value them very clearly on price to earnings, because I don't think many of these have very large debt components, but even if they do, then value them on EV to EBITDA. But I think anything else, if they are using as justifications to value real estate, should be thrown out of the window. I think that benefit of doubt period is gone.
Understood. Rahul, last question. You like consumer discretionary. You believe rural is going to make a comeback. Auto, especially two-wheelers, Hero, there have been a couple of upgrades which have come through this week. You positive on auto, and within that the two-wheeler and 100cc two-wheeler?
So I think the one place that I have been extremely positive again within auto is that auto discretionary, which is why I have preferred iShares overall for a very, very long time. I think even if you looked at the quarterly numbers for iShares this time, they have grown north of 30% or 35%, which has been remarkable. That's not to say that volume growth hasn't happened in the traditional two-wheeler segment, but I think when you look at rural, I would strongly suggest you track a stock called V-Mart Retail because almost 65-70% of their sales come from UP, Bihar, and most of their clientele that goes in shops that have annual incomes of 10 lakhs or lesser. So for us, it's a huge barometer of what that Hindi heartland or rural India is doing. But I think not only Hero, I think even if you looked at something like a Bajaj, which did 6-7% volume growth, I think obviously there has been an election. There has been some spending. I think the finance minister was, got it spot on last time when she increased the tax exemption limits to 12 lakhs. We're not too far away from a budget, just a couple of months away from a budget. So I don't know what's likely to happen there. But I do think that I would still want to play it through premium two-wheelers. The advantage Hero has versus Bajaj is valuation. Yes. I think the advantage Bajaj has over Hero is that almost 70% of its EBITDA now comes from three-wheelers and exports. I think, and the CC that is above what Hero does, which is where they don't have a play. I think one thing that's disappointed for Hero, as it has for Bajaj, is that JV for Triumph and the JV with Harley. That hasn't kicked off, and iShares has just, killed that market sort of completely. Correct. But I would say, I would be indifferent between Hero, Bajaj and TVS. You could have one of the lot. You should have iShares. And I would still say M&M needs to be a core part of your portfolio. I'm not too positive on passenger vehicles. I think the best of the CV cycle is behind us. But if you want to play it, you can probably play it through auto components. But in the OEMs, I'd say one of the three conventional ones, iShares and M&M should be the portfolio.
Rahul, great to have you in the studios. And I know the conversation could go on. I wish we had more time, but next time.
Thank you so much for having me, Aisha, again. Once again, pleasure.
Okay, very quick break. Be right back, and we'll have some corporates join in.